Last week's video sparked a chord with a lot of you, so I went back to the comments, and so for this video, I'm going to do another 1970s video. So many of you were critical about looking back at the past, the 70s, and even the 1930s to compare them today. And I just want to say one thing. I will look at the past, but I will not stare at it. There's a couple things that you cannot dispute that are similarities from the 70s to today. One is that the government was spending a lot of money during that period of time on the war back in the 70s. And currently, they've been spending it because of the pandemic and other issues. In the 70s, we had an oil embargo. And today, we're also using oil as a weapon as we continue to issue sanctions against Russia. And we're now involved in the Israel-Hamas war. Just like in the 70s, we have tensions in the Middle East that could affect our oil prices. And also in the 70s, we had high inflation and uneven growth. We had poverty issues, we had racial injustice issues, and we had crime issues, all of the things that we're all dealing with today. But as my mom used to say, a picture is worth 1,000 words. So in this chart, we're going to take a look at the inflation today versus the 1970s. And while this chart is not an exact replication, it's wildly close to what happened during the 70s. And as the government starts to roll out different programs like oil sanctions or embargoes, or even the federal funds increases to tamp inflation, you're going to see some of the same behaviors as they use some of the very same tools that they did in the 70s. As you might notice, the big gap in 2020 was actually the pandemic. What's crazy, however, is in 1974, the inflation was 9.27%, and in 2022, in June, the inflation was 9.1%. And just like in the 70s, the government did some of the very same things to try to drive inflation down. In fact, in 1975, just 1 year later, the New York Times ran an article that said, this is the start of the recovery. Hopefully, you guys are starting to see some similarities here. In this next slide, I'm going to show you the federal funds rate from 1972, which was 5.33%. And what's crazy, that in August of 2023, it was also 5.33%. The reason why this is so foreign for most of you is that most of you have not seen a federal funds rate this high since about 2007, which my guess is most of you were not investing during that time. So said another way, you've all been very spoiled with these low interest rates, which is exactly the reason we're having this bubble and these inflationary problems. So the real question here is, when the federal funds rate is sitting over 5%, just like it was in the 70s, will it go up or will it go down? In the 70s, it continued to go way up as a result of the high inflation was primarily driven by the oil embargo that we had imposed on us from OPEC or the Saudis as a result of our involvement in the Israeli Yom Kippur War. And many of you might not remember this, but the price of oil went up a lot during this period of time, and so did inflation, because oil is tied to inflation, as I'm going to show you in a minute. So let's take a look at the price of a barrel of oil as adjusted for inflation. If you look at the 70s, the Yom Kippur War, the Arab oil embargo of 1973 actually drove the price of oil from around $20 a barrel to over $45, because most things that consumers need are tied to oil in some way. Then, of course, oil peaked in April of 1980 at $103.76 a barrel. During this time, inflation was 14%. Now, I know for a lot of you, that might be a foreign concept. I'm trying to show you here that the price of oil is a direct result of high inflation. Now, let's fast forward to 2022. On the far right side of the chart, you're going to see oil going up in the 2000s from between $40 and $60 a barrel to over $100 a barrel in February 2022, when inflation was 7.9%, and then it peaked actually at $120.75 a barrel in May of 2022, when inflation was 8.6%. And of course, the next month, it was 9.1% in June of 2022. So what I'm trying to say here is that the price of a barrel of oil definitely affects inflation. And this is one category the Fed just doesn't have a lot of influence over. So as of today, in September 2023, inflation is 3.8%, which is much better than it was. and oil is sitting just under $90 a barrel. So the difference of today is we're now facing two different wars. Obviously, we have the Russia-Ukraine war and we have the Israel-Hamas war. Both are very different. Now we have a Middle East crisis which could disrupt price of oil, and the European Union and the U.S. has issued sanctions against Russia because oil is Russia's main moneymaker. Just like in the 70s when OPEC initiated an embargo against the U.S., the same things are happening now. In this chart, you can see the parallels between oil prices and inflation. If you take a look at the red, you can see the oil prices, and the blue, you'll see the inflation. What I really want you to focus on is when there's a spike in the red, there's also a spike in the blue, with the exception of 2020 when the spike here was the pandemic. What I really want you to pay attention to on the far right side of this chart here with the red line, oil prices clearly started to go up well before Russia invaded Ukraine and the Israel-Hamas wars. And those are still wild cards and something that we all need to watch. So this slide should be rather obvious, but the biggest use of oil is transportation, which represents 66%. And therefore, when oil prices rise, all goods which are transported will be affected by higher transport costs. In fact, there's almost 14 million truckers in the United States, and they're already seeing 50 to 60% increases, and their number one expense, fuel. The point here is that any expense associated with the transportation of goods or services is going to be passed on to the consumer, and it's going to make its way in the form of inflation. So for all of you that are trying to figure out where inflation's going and where interest rates are headed, if oil continues to go up just like it did in the 1970s, well then inflation will also go up, and the Fed will be forced to continue to increase the federal funds rate, which will continue to tamper consumer spending, which of course could send us into a full-on recession. On a positive note, if you own real estate and have fixed rate debt, rising inflation actually helps you because you're paying off the debt with cheaper dollars later. What's actually happening is that your dollars are worth less and it looks like your real estate is going up, but it's really your dollars are being devalued by inflation. So if you own hard assets, hold on to them during this inflationary run, because that is going to be the solution for you to be on the right side of this ledger.